Okay, good morning. We are going to start the next session. We have another great panel today. So, great speakers. The first speaker is Doug McManus, who is overseeing, who's running he's the director of financial research at Freddie Mac. Doug will present his paper.
Great. First, I'd like to thank the organizers for all their hard work in putting together this conference. The views I'm going to express are my own, and they're not necessarily Freddie Mac's. And I'll be speaking as a modeler who's been involved with mortgages and actually mortgage modifications for more than 20 years. I think everyone directly involved with the implementation of loan modifications during the crisis was frustrated at how challenging and complex it was to actually implement these. And it's interesting that this capacity challenge actually wasn't unique to this crisis. If you go back to the 1990s, there are actually very similar experiences with areas that had large house price declines, such as California, Massachusetts. It's reasonable to expect that in future housing market downturns, be they regional or national, they will strain the capacity of servicers, especially if those downturns come after a long period of benign house price appreciation. I think that helps motivate why prepackaging mortgage modification terms into the mortgage contract at origination could potentially be an appealing strategy, especially if they're based on objective criteria, which obviates the need for complex re-underwriting. Also, if these terms are sort of explicit at origination, they'll be costed into the mortgage, and you won't necessitate having to spend public funds to support some of these modifications. What this paper does is examine the potential market impacts of one such possible contract, continuous forbearance mortgages. And would be a contract that would embed insurance that reduces the interest-bearing balance for loans that become underwater. And basically, it would be a contract that would say you'd only pay mortgage interest on that on the portion of your balance that's above the current mark, or pardon me, that you would not pay mortgage interest on the underwater portion of the loan balance. And so here, forbearance is taken to mean sort of a portion of the loan balance that does not accrue interest. And so the interest you pay at any particular month will be based on the minimum of the loan balance and the house price, where the house price is estimated in some objective form. And one of the interesting features of a contract term like this is that it would just automatically scale up savings in mortgage payments with house price declines, and then would automatically taper them back as house prices improve. I think one of the recent lessons in the housing crisis and the data that it's generated is really the potency of payment reduction as a mechanism to reduce default. And that helps motivate this. If you, there are other contracts, but they may be more expensive in terms of the embedded option cost. Ideally, you'd be able to come up with option terms that would be effective at reducing default, lightening the load of servicers, but at the same time would have sort of minimal impact on costs at origination. And part of the exercise that this set of slides will look at is actually the possible stimulative effects of these mortgages. To what extent would, had we had these mortgage designs in place back in 2006, what kind of stimulus would it have given to the economy? Where would that stimulus have been focused? This particular contract is one in a family of contracts. There's Schiller's continuous workout mortgage, Ambrose and Buttermore have an adjustable balance mortgage, Hancock and Passmore have a buy your own mortgage proposal. There's also a price level adjusted mortgage of Modigliani. Again, the motivation why this rather than the others is trying to pick something that's going to adjust payment, which we think is a potent mechanism to reducing default, and in a way that just has a least cost impact on the loans at origination. So we're going to consider a counterfactual of the widespread adoption of this contract prior to the onset of the recent crisis. I'll be assuming, or this analysis assumes, that all outstanding mortgages in 2006 and beyond had this feature. And 2006 is chosen as a starting point, as it can be sort of taken as a worst case scenario. It'll give some sense of an upper bound on the potential sort of macro impacts of these contracts. And we're also going to assume that there are no negative impacts from the forbearance and the resulting reduced mortgage payments. The approach is going to be to create a loan level data set that is weighted to approximate the total population of loans from 2006 through 2013. I should mention, when the National Mortgage Database becomes available, that would be ideal for this problem. Instead, we're going to use a 10% sample of CoreLogic loan level servicing data, and we're going to weight this up to be consistent with Federal Reserve's mortgage debt outstanding data. And that will provide sort of loan level information. We'll use Freddie Mac's SIP level house price index as the basis for updating house price values, and this will allow us to calculate monthly loan level savings based on this data. There are direct and indirect effects. We'll be using the BEA RIMS 2 household multipliers to capture the indirect effects on income and the total impacts on employment of these contracts. I should mention they're based on a Leontief-like model that has some limitations, but it's at least a coherent way to address those indirect effects. The multipliers range from 1 to 1.4, so they're not really driving the results. So what we'll do is we'll use this loan level data and then aggregate it up to assess the impacts. And the first set of results just looked at what the direct impact on mortgage payments would have been. And over this 8-year period, it would have been reached a total of $178 billion, which is not an insignificant amount of stimulus. And also note that the payment reductions are really focused on those states with the largest declines. You can see 61 billion in California, 38 billion in Florida. You're getting a concentration in those places that are hardest hit. Those were the aggregates. A different way of looking at it would be what per capita impacts would be in these regions. And if you look at Nevada, you can see that during sort of 09, 010, or 2010, you're getting about $800 per person in that state sort of injected into Nevada based on these contracts. You can also see the average over 8 years for Nevada is around $400. And again, it tapers down depending on the sort of average impact of the crisis in those various states. To get some sense of size comparison, the 2008 economic stimulus payments, those tax rebates, are in the range of $300 to $600. So it seems like potentially these are meaningful impacts. When you include the BEA multipliers to sort of capture the indirect effects, the total stimulus rises to 225 billion. And when you look at 09, 010, and 11, you see that you're getting about 50 billion a year in stimulus, and that stimulus is very much focused on the states that were hardest hit. You can also see the effect of the tapering, that as the economy improves, these payments taper back. You can use the BEA information to transfer these increases in GDP into employment impacts, and roughly speaking, over the entire period, it would have raised the national level of employment by about 230,000 jobs, or about 1 month of normal job growth. During the concentrated period of 2009 to 2011, you might have seen something on the order of 400,000, an increase in employment by about 400,000. These can be, if you hold participation rates constant, you can translate this into what would have been the impact on the unemployment rate in these states over the period. And you can see Nevada is at the head of the pack on this in the years 2009 to 2011. You're seeing about 1.5 percentage points decline in the unemployment rate, which would roughly be about 10% relative to what they were experiencing at that time. Similar declines would be for Florida and other states that were hardest hit. So in short, that would potentially be the benefits from having contracts like this. However, again, if you try to look at those cash flows, someone's paying for them, and if the mortgage holders are going to be paying this insurance premium, you might ask, how would it affect the fees and rates of a borrower at origination? Ideally, you can view this contract as an embedded house price, series of house price options, and so use derivative pricing techniques to get at the valuation. It would require a risk-neutral distribution over future house prices, or view of that. To do that pricing, we take a simpler approach, but I think it will have the same qualitative effects, or show some of the same qualitative features that would show up in the derivative pricing. So based on historical loan price experience, we calculate what the average cost would have been for these options, and then stratify that by state and by LTV. One thing you can see is that states that tend to have higher volatility of house prices will tend to have higher costs of these embedded options. A second feature is that higher LTVs will also have a higher price of these options. It's an option that's closer to being in the money, so you expect it's a more valuable option, and hence it would require more compensation for an to offset the cost to an investor. A disadvantage when you look at this is that, and if we were to do this based on the derivative pricing, you'd see there'd be a much higher price because the risk premium would be built in. These income flows are happening at a period where generally it's a bad time. Getting insurance for periods like that will be high. It's also going to be the case that the cost is going to depend on the time varying trajectory and volatility of sort of house price expectations, or the house price process. And so you could actually induce a pro-cyclical impact of affordability, where the cost of these options would escalate during a crisis, during a period where there's a housing price downturn. I think this points to maybe sharpening the attention to how to reduce the cost of these options, maybe including conditioning on unemployment, maybe focusing greater declines in house price payments for more underwater borrowers. That I think it's they could also be triggered based on issues like delinquency. So the conclusions, this paper sort of introduces this continuous forbearance mortgage contract, really focusing on how do you solve the implementation problem of easing the burden on servicers during crises. And then we've specifically looked at potentially the sort of macro impacts, the regional impacts of these contracts being in place. They have a number of advantages, being automatically implemented without government involvement, without costly re-underwriting of a loan. They can directly reduce default through the mortgage payments. Also, the regional impacts will potentially assist in reducing default as well. The disadvantages is the cost, that there may be time variance in this cost over time that could be pro-cyclical, and may actually represent overinsurance. In this sample, 1 out of 3 borrowers who had negative equity actually reached foreclosure. And so, sort of as a treatment, you're treating, you're sort of over-treating 2 out of the 3 cases. You're treating people who would not have foreclosed even without this optionality. So a question is, how do you sharpen that to maybe target the more affected group? In any event, I think in conclusion, I think we can anticipate maybe the next crisis that might come in some 20 years or so, and it would be interesting to see what could be done to alleviate some of the operational burdens that occur in some of these crises, and potentially could be done in a way that would have positive macro stability. Thank you.
Thank you, Doug. Bob Avery is going to discuss the paper. Bob is the project director at FHFA, used to be at the board, and he has taught at Cornell and Carnegie Mellon.
Back and forth, okay. Thanks very much, Julapa, and thanks to the organizers. These are always very stimulating events. Learn a lot. Let me say from the outset, these are my views. They're not the views of the Federal Housing Finance Agency or Freddie Mac or probably anybody else's. I think Loretta actually laid out a lot of what the issue is. It's been 7 years since the crisis, and I think it still remains an enigma. On the one hand, you could argue that the losses were really not that significant. $600 or $700 billion. The Dow Jones, about 100 billion per 100. So that's a bad week on the stock market. And yet, 7 years after the crisis, we went into a major, that's, on one hand, doesn't look like that's a very severe loss. But on the other hand, perhaps 5% of homeowners, one estimate, went through a foreclosure. But I think more significantly, 6-month period of time, the unemployment rate doubled. There was a severe loss of confidence in this country. In 1990, for those of us that were there, we wiped out the banking system in New England and Texas. And we don't talk about that as a great crisis, maybe because we don't live in New England and Texas. But what is it that makes this last one different? I think that's an interesting question. And to the extent to which we look for the need to reform, and what, if we are to reform, if there's some lesson to be learned, what exactly are those lessons? And it's 7 years after the crisis. What this paper is really addressing, I think in a very creative way, is to ask about, was an element of the crisis inadequate means of sharing risk? Was risk too concentrated? Are there alternative mechanisms for which that risk could be shared that we would not go through such a severe outcome as we did in 2008. Now, one thing I would say to the authors, if you're going to come up with a product, you need a much more catchy name than what you have. So I think the premise of this paper is similar to what QRM is. There's some view that if you share risk in a different way, somehow the outcomes might be different. There was too much moral hazard, incentives to make loans that the risk was passed on to others. This is offering an intriguing new product, and there are others here, as Doug mentioned, that would insure a mortgagee against negative equity. It's a particular way of doing it, reduce the payment in some proportion to the loss, and they pick one, but you could pick other ways in which the payment could be altered in response to a negative equity. One of the interesting features that Doug didn't talk about is this. What one of the effects would be is that the homeowner would have an initial incentive to stay in their house, and only the homeowner would. Nobody else would. What you've done is create the homeowner is the party with the most cheapest cost of staying in that house as opposed to somebody else. And it's a little bribe for them to do that. If they lose that, if they leave, they'll lose that. So that's an interesting feature. But if we step back and all of the insurance programs that might be offered, I think the fundamental question that has to be addressed to each of these is, well, what problem are they solving? So let's start with the consumer. So is Doug's product helping the consumer? And there's an interesting way of looking at that. There are very few insurance products that insure you against bad investments. If you look at deposit insurance, think of government insurance of some sort, SIPC, deposit insurance, the pension guarantee fund, they're really all insurance against fraud rather than luck or stupidity. It's very difficult to get, there aren't insurance products against stupidity. Flood insurance is one possible exception where you might argue the government is involved in a insurance product against loss, but that's really more a form of hazard insurance, not really investment insurance. Now, it's hard to make the case that housing should be an exception. If we don't have products to insure your stock market investments, why should we for housing? In fact, I could argue housing is one of the areas you'd be least likely to do it. Housing, as we all know, is an interesting mixture of housing services and an investment. If your house is underwater, most of us suffered a loss in 2008. Nobody moved. The house has the same number of rooms, has the same neighborhood. The housing services, you could argue, don't change at all. And if your income didn't go down, nothing about your environment changed. The shadow price of your house simply went down. Why would you want to insure against that event? What you insure against real losses, real changes in your consumption or your current environment, but not a shadow price on the value of your house. And furthermore, most real estate economists, I think one of the reasons we so fundamentally failed in 2008 is the traditional market has been, that's exactly what consumers do. House prices go down, they just sit in their house, they make their payments, they don't really care that they're underwater, and then fundamentals catch up, you just don't have a lot of trades, and then you go on to the next cycle. That's been the traditional market in real estate, which suggests consumers aren't particularly sensitive to being underwater. Furthermore, you can actually buy this insurance right now. So if this is in fact important, you can buy insurance against a loss. You can tie it to unemployment. It has to be involuntary unemployment, but you can go out and buy a product which, when you take out your mortgage, in which you can be paid, have your mortgage payment be paid if you have a loss of job or disability. This would be a similar kind of insurance. Durkin and Ellhausen looked at this issue in a Federal Reserve Bulletin article a couple of years ago, and they found that about 23% of consumers had such a product, something like that, down from about 30% in 2001. Now, we just started a national survey of mortgage borrowers and took a look at 2013, and only 3% of people had this product. So I'm not sure that Greg's and Tom's numbers are quite right. What was interesting is that 24% of our people didn't know whether they had this product. that doesn't suggest to me that there's a huge demand out there on the part of consumers for this sort of product. Systemic risk is what the way Doug looked at this and said, well, this is really a form of automatic stabilization. And it's targeted, it'd be a way of mechanically providing stimulus monies for states and areas. If you view that how negative housing equity is a way of targeting such aid, this would be a way of doing it very mechanically. It's very similar to using the GCs, as will be proposed by many, make them counter-cyclical. They could be argued that's a similar sort of automatic stabilization, although they're interestingly different. Doug's program would encourage people to stay in their house, so you subsidize that, whereas subsidizing mortgages through the GSEs in a counter-cyclical way is a way of subsidizing them being able to move from house to house or to get out of their house and have somebody else move in. So they're interesting, two different problems they seem to be targeting. I think the difficulty with this as a stabilization program, though, is it goes to many, many people, as Doug said, that don't need it. People like people in this room don't really need that money. Their house may be underwater, but they don't really, that money it's not affecting their behavior. You have to believe that things like unemployment insurance or variants on that are just much more effective ways of targeting stabilization money at the parties in which it's most likely to have an effect. If you're going to do this, it has to be universal. As the Ella House data say, if you make it available, people won't get it. If you want it to be there, you're going to have to make people get it, and you're going to have to make them get it when times are good. So it's going to have to be mandatory. It'll have to be like unemployment insurance. So you're going to have to sell it. So I think that's the challenge. Now that's sort of a damper on this idea. But however, when I thought about it more, I thought, well, maybe there is something to this. And where is it? I think it's potentially in the case for the investors. If you think about what Ginnie Mae insurance does, the real problem we haven't solved is to bring back the private mortgage-backed securities market and ask what are the impediments to that, and what sort of concerns do investors have. And so I thought about this in a similar way you think about Ginnie Mae insurance. Potentially this is a form of insurance for investors. You could view this as guaranteeing that their payments will be made when, not guaranteeing, but encouraging those payments to be made when houses are underwater, when consumers, it's a bribe, it's an extra bribe to keep the consumer in that house in times in which they might be inclined to leave. We're looking for some sort of backstop insurance. We're struggling for ways, if we believe the government must play some role in bringing back the private label market or the GSE market of the future. What's the kind of insurance that could be offered that has a relatively light touch, that isn't just a heavy subsidy for everything? Maybe a variant of this kind of program could be that kind of light touch, where you provide an extra level of backstop insurance that creates a comfort level for investors, which can help bring that market back. My sense is that if you're going to make an argument for this program, that's where the most compelling case can be made. So I encourage Doug to continue working on this. It is an innovative, we need more of this sort of thinking, and I look forward to more variants on it in the future. Thank you.
Thank you, Bob. We can take one question, a little behind, Andy.
Doug, have you considered combining this with making the loans full recourse rather than non-recourse loans? Because that would
that's interesting.
drive down the cost, and then also make sure that the money that came from either the insurance or whatever
Right.
they index it to the mortgage and discourage any
Yes.
strategic default.
Yes, you could balance the costs that way. It's also worth noting that the way costing gets done sort of now as it is, it embeds a cost of sort of the current system of mortgage modification in a crisis. And so, if there are mutually beneficial modifications that aren't being done because of implementation inefficiencies, that's another area where potentially there would be a gain that's not captured.
We'll take one more, Leonard.
So what I would worry about this problem is
Could you
that you're
speak, use
encouraging,
the microphone?
worry about this product that you're encouraging risk-taking at the peak of the boom, right? So unless you're really able to price the option very closely, you make this product more taking a mortgage more attractive as the risk gets higher. And one of the big problems that we have is that, you know, the mortgage sector in general tends to encourage risk-taking as part of the boom. And so I would worry about that.
Yes, I think it is interesting that, I think that concern would be stronger with the Schiller-like continuous workout mortgages, because there you're fully insuring the collateral of the home buyer. Whereas here it's very much partial benefit. It has some option value, but it's likely to be well short of the full equity amount. But that would have some incentives on risk taking. That's a good point.
So it looks like there are more questions, but can we just wait to the end? Because we are running out of time. Our next speaker is Tracy, who is Executive Vice President at the New York Fed, previously Director of Research. Joe has also taught at Yale and Columbia.
Thank you. Good morning, and let me also just list this disclaimer that these will be my own views and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. It's a delight to be here, and I'm looking forward to the concept of tag team discussants in a moment. So this is work with Josh Wright, who has actually now left the bank for Bloomberg, but looking at this question that Doug raised, which is the impact of payment changes on default risks. This is very important for a lot of programs, including, as we're going to talk about, the HARP program. So the household credit channel is an important channel for monetary policy transmission. One aspect of that is how lower interest rates generally flow through the household credit, but in particular lower mortgage rates. And that's going to vary by the type of mortgage product that the household selected. For adjustable rate mortgages, that flow through happens sort of automatically. No actions have to be taken by the borrower. For fixed rate mortgages, which tend to still be quite prominent in the US, there's a need to refinance the mortgage in order to take advantage of those lower mortgage rates. So absent stress in the housing market, borrowers should have enough equity to be able to do the refinance. So then it becomes simply a decision. Are the upfront costs incurred by the refinance going to be recouped through the lower monthly payments based on some expectation of how long the household expects to be in that new mortgage? So not so different from a decision at the very front end, do you buy down your rate or not buy down your rate? It depends on an expected duration. However, as we saw with the housing crisis and these declines in house prices, it left many borrowers, shall we say, collateral constrained. They didn't have sufficient equity to be able to do the refinance. They may have also been credit constrained in the sense that their credit would have made any kind of refinancing, if they had the equity, more expensive. So this lower negative equity for a while has been known to be a friction to refinance. We talked about earlier the downturn in New England. Andy Kaplan and I studied that back in the 90s and saw that this very same phenomena where refinancing in New England was held back because of declines in house prices. And we argued at that point in time, having some kind of streamlined refinance program for high LTV mortgages might be useful. So during the crisis, obviously this was no longer just a regional problem, but much more national. And there were many folks who proposed the idea of broad-based high LTV refinance programs. Good examples are Boyce, Hubbard, and Mayer in 2011. Again, arguing that these lower monthly payments would help households manage, in some sense, the repair of their balance sheet, the process that Loretta talked about this morning, support consumer spending. Now, it is important, I guess, from a macro perspective to recognize that refinancing ultimately is an income transfer between investors to borrowers. So when we think about how much macro stimulus that, it's not just the aggregate amount of those, but it's sort of differences in the marginal propensity to consume between the investors and the borrowers, and also the degree to which you have foreign investors, because we may not sort of count them into that calculation. But putting that aside, the other important consideration when we think about HARP is that obviously it's directed at the GSEs, which were at the time in conservatorship. Now, there's lots of different interpretations of what does conservatorship mean, but the objective was to preserve capital. So one question is, would a program for high loan-to-value refinancing for the GSEs actually help improve capital? There is going to be a fundamental trade-off. Again, these are all credit risks that are underway already. The GSEs could induce more of these refinances in a program by lowering the G fees, much like FHA did on the streamlined refis. So you're going to give up fee income at the front end, and the question is, how much do you make up by lower credit losses on the back end to figure out where the right trade-off is there? The other complication in the GSE context is they are also investors. And so you'd be wanting to think about the loss of income from their portfolio. We don't try to carry out a full analysis like this, but it is important as a component of that analysis to be able to analyze that back end. How much would you save in terms of expected credit losses if you could induce more refinances through HARP? Let me actually skip over the discussion of the HARP 1 and its challenges and sort of HARP 2, where I think they really addressed many of them, and get at this key question, which is, how do we try to estimate the potential impact that a HARP program would have? So refinancing for high LTV borrowers on future credit losses. And there's a number of alternatives you could think in terms of approaches. The most, I think, obvious first one, if you have access to the data, is, well, let's just go into the data and link HARP refinances to their prior mortgages. That gives you the ability to see the actual reduction in mortgage payment. You can look at the behavior of the folks who actually took up the HARP program and try to compare them to some control set of borrowers, and then look and see if you can estimate the impact of the payment reduction. The difficulties in this type of analysis, which has been carried out by Freddie on their internal data, is we have to control for the qualification requirements, which in HARP were that you had a clean payment history at the time you applied. So we know, all else the same, a borrower with a clean payment history is going to have better performance going forward, so we'd have to control for that. And also the borrower's decision to actually take up the program. Again, they feel like they're going to get more benefits than the cost of the refi. So that's going to generate selection effects that we're going to have to control for to isolate just the monthly payment effect. Another alternative is we could go back to modifications and look at the non-prime mortgage modifications. I did some of this work with some of my colleagues, other work in this area. The challenge there is to generalize those modification results, which do find an effect in terms of lower redefault for some of these modified mortgages to a HARP population. Very different set of borrowers. We're comparing prime to non-prime. And also, HARP is about initial default. The modifications were about redefault. Those might be very different processes, and so it's not clear that we should try to generalize the results from the non-prime modifications. Another alternative is to look at adjustable rate mortgages. And I have colleague Andreas Fuster with Paul Willen. They looked at hybrid ARMs, which are really nice because you see fairly significant payment adjustments at a concentrated point in time for seasoned borrowers. So that's much similar to the dynamics that are going to go on in the HARP program. But again, you have the problem, they're not prime borrowers. So what Josh and I tried to do instead is to look at prime adjustable rate mortgages to try to match up similar quality borrowers that we would see for the HARP program. Now the payment changes, however, they have the feature that they're not conditional on payment history, so we don't have to worry about that. And there's no participation decision or take-up decision, so those are good. But we have to control, instead of for those effects, we have to control for the choice by the borrower initially to take the adjustable over the fixed rate mortgage. And the question is, what is going to be easier, the original selection coming from a choice of the mortgage product, or this dynamic selection coming from the clean payment history and a decision to take up a HARP refi? We think it's worth trying to think about just controlling for that original choice of product. And we turn to some work by Calhoun and Deng, published in 2002, where they did a very nice side-by-side risk model for agency fixed and adjustable rate mortgages. What was very nice about it, it's the same statistical methodology, same sample selection, same explanatory variables. So again, literally side by side. And the unobserved borrower risk factors that may differ between those who chose the adjustable versus a fixed, the idea is that that would show up in the baseline hazards for the prepayment and the default. The findings from Ding and Calhoun were that they found very similar responses to the observed risk factors that they could control for. And when you looked at sort of the unobserved risk factors from the prism of prepayment, they found very similar prepayment baseline hazards. So not really any difference in how the choice of the product manifested itself in prepayment behavior. But when they looked at default behavior, they found that the baseline default hazard for the adjustable rate mortgages initially was above that for the fixed rate mortgages for the initial first 2 years, confirming a lot of people's suspicion that in many unobserved ways, folks who chose adjustable rate mortgages might be riskier at the margin. But then after 2 years, the adjustable baseline default hazard fell below that for the fixed. So this suggests one strategy that we're going to follow, which is we can try to use seasoning to basically adjust for this unobserved heterogeneity between the prime and adjustable borrowers for that choice of product. The challenge is that the mortgages that were analyzed by Calhoun and Ding were originated in the 90s. So what we decided to do was to basically update their analysis, and we looked at mortgages that were originated between 2003 and 2008 and followed them up to the beginning of HARP. So looking at performance up to June 2009. Again, same side-by-side comparison that they did. So here we're just showing you the estimated baseline default hazards, and we find the exact same result that they found for data basically more than a decade earlier, which is that initially the baseline default hazard for adjustable rate mortgages is higher than that for the fixed, but the crossing is somewhere around 2 years. So what we're going to try to do then is use this 2-year seasoning as a way that we're going to account for, in some sense, this unobserved heterogeneity differences between the two products. That actually works very nicely when we look at the age of many of the HARP refinances. So turning back to the Freddie data, they give you the distribution of those loans that HARPed, the origination dates on the prior mortgage. And so what we do is we basically match our adjustable rate sample across these origination years to follow the exact same kind of distribution that was showed up in the Freddie data. And we use the following rule that you will enter our estimation sample at either June 2009 if you're at least 2 years seasoned by then, so the beginning of HARP, or at your 2-year anniversary. So all of our loans will be seasoned at least 2 years. We also impose the clean payment history and a current LTV estimated above 80 when that loan enters into our sample, again, to try to match up with potentially loans that would be eligible for HARP. So we use the LPS loan level data on GSE-backed adjustable rate mortgages. We focus on those originated 2003 onwards. We have some restrictions on the origination LTV and balances, and we end up with roughly 160,000 mortgages to look at. And then we follow to either when the loan is paid off or the first time the loan hits a 90-day delinquency, which will be our default measure. We have the information on the structure of the ARM, and so we can calculate these payment changes. What we can't do as nicely as Fuster and Willen is they see these very dramatic declines in payments at a point in time. We're going to be accumulating, in some sense, these smaller payment changes to try to get to cumulative payment changes that are closer to what we observed under HARP. We also need to basically try to control for other factors that may affect prepayment and default behavior. And these are going to be both static and dynamic in nature. And so again, we use a competing risk standard sort of setup. We have borrower-specific factors such as the origination credit score and DTI, both static. Several mortgage-specific factors, current loan-to-value estimated as a dynamic, the loan purpose, documentation status, origination balance and term, property-specific, what property type, and then some local economic. We merge in unemployment rates, a recent change in house prices, and an indicator we construct for distressed sales in an area, an interest rate incentive, for these folks, which is dynamic. And then fixed effects, both origination year, year, quarter time effects, and then state effects. When we look at some of the non-payment results, they all are very similar if you've done work in this area on loan to value. If you compare folks below 80 to above 120, default increases like 4 times the baseline. Prepayment decreases by 55%. That's that collateral constraint that we identified earlier with my colleague Andy Kaplan. When you look at high credit, so above 780 to low credit, below 580, default increases 48%. Prepayment decreases by 42. Similar things for debt to income, loan purpose, and local economic. The one thing that we didn't find any evidence of was sort of contagion effects. So the more distressed sales going on in your area relative to the house stock, no measured impact on default by the borrowers that we could tell. So the key is looking at these monthly payment changes. We allow for asymmetric effects between an increase in the payment and a reduction in the payment, and also asymmetry between borrowers who are below 80, those who would not have been sort of targeted by HARP, and those who had above 80 based on our estimates. And so here we show you just those, and these are exponentiated hazards. So focusing on the decrease in monthly payments for the borrowers who would be targeted by HARP, so we estimate their loan to value to be above 80, we see that there's about a 9.5% decrease in the monthly default risk, but also a decrease in the prepayment risk. So this tells us we've got competing things going on in the data, which is these folks would appear to be then less likely to default, but they're going to be exposed to default for a longer period of time because the prepayment risk also goes down. So we have to see how those two factors sort of play out against each other. We had to use this idea of accumulating the payment changes. Is that a reasonable thing? Well, here we break up the data into the current payment change and the lagged previous payment change. And if we look at folks who were, where we have decreases where you're below 80, we see that this idea that you can basically just add them together is fine. We do find, however, for our target group, which is above 80, a much stronger effect from the most recent payment reduction than from sort of the cumulative payment reduction. So that would say that we're probably going to be underestimating, in some sense, our results. And this is also, I guess, a factor in favor of the Fuster-Willen, which concentrate on these big payment reductions. So what we do is we take the average refinance percentage reduction in the monthly payment reported from the Freddie data, and we do a 5-year, basically, extrapolation. And we find a decrease in the cumulative default probability by about 160 basis points. So we have to map that into credit losses, we need to basically also come up with a loss given default. We used some earlier data by Kui and Yang. While it was published in 2009, the data on their losses predate the financial crisis. So I think it's going to be conservative. We basically figure out from our 5-year extraction the probability, how many of our losses, or predicted losses, are in these different LTV buckets that Kui and Yang look at, and we come up with a weighted average, a default weighted average of about 35.2% of a loss given default. So when we combine that with the 160 basis points, we find about a 56 basis point decline in expected credit losses coming out of a typical type of HARP refinance. When we compare that to the Freddie results, ours are lower than theirs. One possibility might, again, be this difference between trying to control for the initial product choice versus the dynamic selection. And I'll end there. Thank you.
Thank you, Joe. We have 2 discussants for this paper. We are experimenting a new format for this in this session, and so I was thinking, Rich, the first speaker, the first discussant. Let's say Rich would go first, right? Or Wenli would go first. So Wenli is a senior economic advisor here at Philadelphia Fed. She is going to be on sabbatical at Princeton University starting this fall.
Thank you, Julapa and Paul, for putting together this nice conference and for giving me the opportunity to discuss the paper that I really enjoyed reading. Just to recap, the paper studies the relationship between changes in monthly mortgage payments and also the mortgage default rates. And the paper makes two contributions to the literature. So they very creatively constructed this data set which allowed them to overcome a series of selection bias issues that has plagued other papers in the literature. And also the loans that's in the sample are more comparable to those eligible for HARP. And hence the policy estimates are more relevant and reliable. So I really don't have a whole lot to say, so, but there's a discussion I have to quibble with you on some of the points. So basically I have only two kind of, somewhat big complaints. One is I would like to see a bit more on the fluctuation of the monthly payments. And it happened during an interesting period, which I will elaborate a bit more. So where did the changes come from? And secondly, I guess I'm not entirely convinced about the comparability with the HARP sample. A few words about existing literature. I know Joe has done a great job going over all the papers in details. Perhaps it's worth stressing, just so that we get an idea what are the selection bias issues we worry about in this literature. So there are, basically one can classify the papers into four categories. One is directly studying this loans being modified under the government programs, HARP in particular. And obviously there's a selection bias coming from the participation decision by the borrowers. The second are the mortgage modification programs, either the private modification prior to the government programs, or with HAM, there are a few papers on that. Again, the selection bias comes into the modification decisions, either by the lenders or by the borrowers to participate in the government program. And then also for the particular question of what's the effectiveness of HARP on this doesn't, the sample is very different. And the third is the refinance loans, the ELU paper we've seen yesterday. And I think that's actually really nice in the sense that it provides a very nice instrument. And of course, the downside is that the sample is not something that would be eligible for HARP. And finally is this paper, which uses similar, is the Fuster and Whelan paper, which is very similar in spirit and methodology to the paper we're studying, which basically you studies ARMS and the changes its monthly payments from the adjustable rate, from rates changes. So this is a chart which I plotted 1 month Treasury bill yield. As you can see that there's a big up and down between 04 and perhaps the end of 08, and afterwards there's hardly anything going on. And ARMS are typically indexed to the short-term interest rates. And if I understand correctly, I think the data basically studies loan performances, after June 2009. So which means, very little movements. If the loan is already gone, there's hardly any movement. So I suspect the changes in payments are coming off loans perhaps the fixed periods expired, and because I guess what happens is the fixed period's interest rate is actually higher than the prevailing adjustable rate. So. But then the question is, why didn't those loans refinance earlier? I suppose there are probably penalties, as is typical, but that's more typical with the subprime. So I'm not sure about the prime. And then the other question is, where did the monthly payments going up come from? That's very puzzling. And the only thing I can think of is perhaps teaser rate, but it's hard to think about teaser rate lower than this 4. So I guess my point is, it would be very helpful to kind of elaborate on that more, because that's sort of the key for the paper. And the second is really, it's a very hard question trying to get around all the selection bias, coming up with comparable samples to those that the government programs try to cover. So I guess I read this chart somewhat differently than Joe, and to me, there is a difference prior to 2 years, meaning that the ARMS are more likely to default. But then afterwards, it seems to me that they're less likely to default. So I guess we can argue prior to 2 years they're different, and afterwards they're not. To me, I still kind of see a difference there. And also, Renee helped me a little bit to play with his data, which sort of has some overlap with this data. So we do see the ARM prime guys tend to be more liquidity constrained, meaning that they have higher credit card utilization rate. So this is not at the origination, but as you follow them. And so I guess, so I've been thinking about all these papers, right, including the ones we just kind of went through in the literature survey. So we're really trying to get at a policy question, which is what's the most effective policy, right? So this one is really not in the sense that it tells us, absent of any of those coercions from the government, you know, any incentive changes, what happens if you just simply have the amount of payments changing. And then the other paper study, okay, suppose you have all these requirements, what do things change? And it's just, I guess, you know, in terms of thinking through the design of an optimal policy, and I feel like we probably still need to go to a structural model, so that would kind of overcome the Lucas critique type of concerns. And you know, there's a Campbell-Coco paper, and there's shamelessly my own paper, work in progress. So there, once you sort of model these guys' behavior, you know, also worry about interaction between borrowers and lenders, and allow roles for government, perhaps we can think more, you know, about the ultimate question, which is what is the right policy tool to deal with these issues. And having said that, and I think this is a great paper and very well written and very well executed, I recommend to all of you.
Thank you very much, Wenli. Another discussant is Rich Rosen, who is Vice President and Senior Economic Advisor at Chicago Fed. Rich has been spending much of his time in Basel, Switzerland, 5 more trips this summer. So we are happy to have him here.
Thank you. Usual disclaimer applies, and I probably should have a second disclaimer, which is it's tough to be the second discussant because you don't want to overlap and you don't want to say something completely orthogonal. I think we're much more on the overlap than the orthogonal here. Let me start by saying I enjoyed this paper. It's an interesting paper with a sort of novel way of estimating the sort of credit losses associated with HARP. But I also want to say, and this isn't about this paper at all, that I mean, in looking at the papers throughout this conference, it seems that each of these papers adds a little piece to the puzzle of how to understand, in this case, mortgage borrower, but in general, borrower behavior. And I'm just wondering, and this may be indirectly what Wenli was talking about with their comment about structural models, but these all seem to be separate pieces, and some of them are closely related, like Ronell's paper and yesterday and this one. But it'd be nice if we could somehow put these pieces together in a more complete way to give us a more complete way of borrower behavior. And again, a sort of good structural model might be the best way to do this. So the key question in the paper is, what are the effect of lower mortgage payments, such as you get with something like HARP, on default probabilities? And the problem the authors faced is that they wanted to answer this question for fixed rate mortgages, but there are selection and other issues with estimating this directly. And as Joe said, the paper by Zhu et al., and I don't know whether you're Ed or Al, Doug. Well, you're one of those two, yeah. Use the Freddie Mac data to try and do this directly, but as Joe said, you know, the selection issue there is that you not only must be eligible with a clean payment history, but you must also select to refi. And so what the authors of this paper decided to do was to estimate the effect of lower payments on fixed rate mortgages using lower payments on adjustable rate mortgages. And it's similar in spirit to the Fuster and Willen paper, again, that Joe mentioned, who used these interest-only ARMs, where there was a natural, if you had a 5-year reset versus a 7-year reset, you had a natural experiment where you could see big drops in payments. But again, both with this paper and that, there are a different set of selection and other issues, which I'll get to in a minute, or some of which I'll get to in a minute. And here's where we'll see a little bit of repeat. This is the chart that Joe put up, which I think is figure 2 in the current version of the paper, but where he showed that the benefits of lower payments as estimated by his model. And so you can see the red line is if payments weren't changed, and the blue line is the forecasted default rate given the adjustment in payments from HARP. And you can see, as Joe said, there's a 160 basis point difference. So that's the gain that they estimate from reduced payments. Now, the reason I put this chart up is both to show you that and to sort of point out something that, I don't know, no pointer. If you look at that red line, and again, it's a forecasted model, not an actual model, but the 5-year default rate for prime ARMs is estimated to be about 30% total. And that just seemed a little high to me, and I'm not quite sure why it was high, or if it, I've never really thought about ARM default rate, so I don't know that it actually is, but it just struck me as a fairly big number. But there does appear to be a gain, and the question is, what's going on? And here, we saw yesterday, and we saw Joe again today, sort of point out these other studies. And I would like to see a sort of more direct comparison and to understand what are the differences and what are causing them. So here we see a 13.8% reduction in payment over 5 years is this 160 basis point decrease in defaults. In the Freddie paper that Doug worked on, they estimate a 10% reduction in payment is a 10% reduction in monthly default probability, and Fuster and Willen have a 50% reduction in payment yields a 55% reduction in monthly delinquency hazard. And the reason I sort of refer to that differently is instead of 90 days, they use 60 days past due as their measure of delinquency. So the other papers have about a twice as big a reduction as estimated in this paper, and I would like to sort of have a better understanding of why. And it may be, as Joe said, that here there's a series of small payment reductions instead of a single large one. But understanding that might help us get at what I think is the big meta question here, which is why do borrowers default? And I'll sort of talk about that in a few different ways as we go along. Actually, before I go on, let me point out one thing that struck me yesterday that's not in my slides. So the model in this paper is a competing hazards model, which when I read the paper seemed like the right way to approach things. It seemed very reasonable. You're looking at default, you're looking at prepayment. And then yesterday we had a couple papers, they're using competing hazards, it's the same thing, and everybody seems to be using that. And I don't see any reason that there's a problem with this model, but it just struck me that there's model risk, that everybody's using the same model, and if there is some flaw in this model that we don't understand, every single study is going to have that flaw. And it just sort of, I don't know what to make of that, but everyone, I mean, there's different samples here, but everyone's approaching the problem the same way. And it seems to me, the problem, one could argue the problem with sort of evaluating mortgages prior to the crisis was many people were using the same model and they turned out to be the wrong model. Nothing more than that. So let me quickly run through a few other things. One thing I'd like to see in this paper and all others is really an understanding of confidence intervals. These estimates are point estimates, not confidence intervals. In some sense, are they actually statistically different? And more generally, if we change the sample period, if we change the seasoning, how does that affect the estimates, and how confident can we be about the actual magnitudes rather than just the direction? And again, the same thing for the final statement. Selection issues. Wenli went through some of this. ARMs are not the same as fixed rate mortgages. It's not 100% clear that the borrowers are very similar. There's an issue with ARMs repricing again, although I'm not sure how serious that is. It really depends on why borrowers default. If borrowers are really defaulting because they can't make the payments, then unless the repricing is very quick, you only care about the current payments you have to make. Either you can make them or you're not. but that's another way that ARMs and fixed rate mortgages might be different. Finally, let me just say that this analysis suggests borrowers may be financially constrained, and it'd be nice to sort of focus potentially on those more constrained borrowers. Can we predict which borrowers are more likely to react to payment reductions in terms of practically in the regressions, add some interaction terms or split the samples? Are HARP-like programs of benefits to borrowers that are not financially constrained? This gets at the similar thing to what Doug was talking about. I mean, are these payment reductions at all useful to borrowers who aren't financially constrained? And finally, I'd like to sort of see the predictions in this model are basically a sort of static future framework. We might be able to sort of say, well, if things get worse, what happens? If things get better, what happens? And sort of use this model to forecast how lower payments affect borrowers' behavior under various different scenarios. And with that, let me just conclude by saying I did think this was a very interesting paper, and it's very well written and easy to understand, and I think you should read it.
Thank you, Rich. So two discussants now. Do we have any questions from the floor? Okay, no question. The next speaker is Larry Cordell, Vice President here in Philadelphia Fed. Larry is in charge of the famous radar group. So he's a go-to person for all kinds of data, including CCAR data.
Okay, well, thanks a lot, Julapa, for the conference. This paper does not merit two discussants, but it does have a longer title. And it's made longer by the fact that what we wanted to do in this paper was to add on a preliminary look at the new mortgage servicing rules. We actually presented this paper at the CFPB recently, and I want to thank the people at the CFPB, hopefully, for making it better. This paper is actually comes out of started at a financial stability briefing that Loretta Mester started. I don't think she's here in the audience, but I want to thank Loretta for it, because I think Lauren Lambie-Hansen, my co-author, would agree we probably wouldn't have done this paper if it hadn't been for the financial stability briefing, and it wouldn't have been made as good if it wasn't for the constant badgering of Mitch Berlin, who actually challenged us to support our statements in the paper. So I want to thank them as well. After all those thanks, any of the problems, of course, are ours and all, but. When I actually started this work in 2011, and Gregory McDonald, who's a good friend of mine, works at JP Morgan, he said, my God, you're doing another paper on foreclosure timelines. And the reason why is because of this picture here, is the timeline started going up in 2011. We started noting it. I'll get into the reasons for this, but they've never stopped going down. So we've gone through the financial crisis, supposedly. The backlog of foreclosures has cleared itself, but the timelines just continue to go up, and I'm going to discuss that and some of the implications of that. Well, of course, the obvious challenge here is that we do observe this positive correlation between timelines and costs. So one of the very first questions that we wanted to ask is, how big are these costs? Okay, so that was an important part of the paper. The other thing is, while we've got increased costs, are these offset by increased benefits to the borrowers? So, there's a justification for them if we can if there's, benefits there. And of course, are there other costs? Now, what we're really doing in this paper is we're updating the findings of several papers. This is another mention of Paul Willen, so maybe we should call this conference the Paul Willen Derivative Works Conference. That might be a little more accurate description of it here. But you can see that it's our paper, Paul's paper with Lauren and Chris Girardi, who are here in the audience right now. We basically updated that. And we've also updated some other papers as well, Joe Tracy being one of them. So everybody here is probably going to recognize their work. Okay, well, there's three main takeaways that we have. So we weren't surprised that timeline costs went up. What we were surprised is that what we were surprised by is how much these time-related costs went up. And we're going to say 15 percentage points in the judicial states. Those are the states that kind of require the judicial review. I'll talk about that shortly. The other surprising finding, and this was out of Lawrence, Chris's, and Paul's paper, is that the foreclosure delays do not lead to more cures or modifications, just more persistently delinquent borrowers. And we couldn't really find many other benefits. And also, I mean, we talk about these negative externalities that happen. I'm going to talk about that as well. You know, there's a number of factors that I'm going to try and get it. Well, the bottom line, first is that the judicial foreclosures imposes large costs with few or any offsetting benefits. And I think the new CFPB servicing rules, what we're hopeful is that it is going to increase more successful modifications. But it's pretty clear that they're further extending timelines. So we have to be, I think we have to be mindful of that as well. So there's important policy pieces here as well. In fact, I'm going to argue at the end of the paper, there's a lot of evidence that this is actually, that these costs are actually leading to a tightening of the credit box, or at least that's what some of the speculation is. And perhaps even effects on the private label securitization market as well. So I'm going to take you through this here as well. There's five items here. We're going to start with the legal and regulatory environment. Now, since many of the people in this audience actually are papers that we're updating, you're probably very familiar with this issue. But the judicial foreclosure review adds time because the lender must petition the court, which then executes the foreclosure by auctioning the property. There's 22 states of that. Statutory foreclosures or power of sale, the borrower really gives up that right. And so that is essentially the big difference in the timelines. For the redemption states, they have post-foreclosure rights of redemption. So that's actually an additional delay that gets added on here. And if you look at if you actually look at a map of this, what you see is that that they're highly concentrated in geographic areas here. The judicial states in the northeast. And if you look, and I've had this verified by Andrew Gent, because of the Homestead Act, a lot of the redemption states are in the center of the country, which is kind of an interesting corollary to this. Paul and Lauren and Chris in their paper talk about kind of the historical development of some of these rules. But what this points to is that while I'm going to present these results, underlying these things are models that are multivariate models that are going to try and control for all of these, geographic effects. So I'll talk about the first model right now. Okay, so we'll talk a little bit about the regulatory environment here because that's actually going to affect things quite a bit. The first period here, and like I said, what we wanted to do is really show the long history of this. So we have over 3 million foreclosures. It's a 16-year time period to show how different the current environment is relative to what's gone on historically. So the first sub-period here, we have 98 to 2007, right up to the crisis. The timelines average around 25 months for judicial states, 19 months for statutory states, so about a 6-month difference there. And it translated into a couple basis points in guarantee fees when I was working at Freddie when we did that, so it wasn't something that we bothered a lot about. Now, they started going up in November of 2008 when the GSEs announced a moratorium on foreclosures, quickly followed by the largest servicers. And their attempt there was really to allow the incoming Obama administration an opportunity to develop their new policies, one of which on the modification program became the Home Affordable Mortgage Program, or HAMP. And of course, HARP was another program that Joe talked about. Okay, so the timelines went up a bit during this period here. You can kind of see them going up. And that's really when I started my work because I wanted to start measuring it. Well, shortly after we started putting our stuff together, that's when the robo-signing period hit. And you can see just an immediate jump in the timelines. Now, robo-signing occurred due to the requirement in judicial states that affidavits be filed with each foreclosure action where the lender must prove the homeowner defaulted on the mortgage and that the lender owns the mortgage. What the investigation proved that the servicers were simply signing these affidavits en masse, hence the term robo-signing. Well, what happened when this was uncovered was that the largest servicers immediately froze their foreclosures while they worked out the legal issues. As you can see, the timeline shot up. And it's kind of interesting because we spent a lot of time on this data here. What you see in here, and this is actually pretty complicated data, but when you spend enough time, you get real interesting results. So in here, you see the shortest timelines are actually right after the financial crisis started, right up until this GSE moratorium. Those are actually the shortest timelines, and that could be, one speculation is that could be the effect of the robo-signing. The reason I say that is because the foreclosures exploded during this period, but the timelines in the judicial states actually went down. So that's kind of an interesting speculation. But that's what's great when you have, when you have really good data, you kind of, pull these things out as well. Okay, so after the roll was signing, the Attorney General's settlement occurred in January of 2012, and so I thought, well, maybe after that, these timelines are going to start to stabilize. They didn't do that. The new CFPB servicing rules were first issued in January of 2013, finalized in January of 2014, and that became our final period. Now, surprising as these numbers are, they actually understate the timelines. Why? Because you have censored observations. So at the end of the sample period, there's I forget how many hundreds of thousands of loans that were defaulted, but they hadn't yet gone through the REO liquidation process. So that's what this part of the thing. I can tell you this is a hazard model, but it's not a competing risk hazard model, Rich. So hopefully it doesn't fail from the same problems. Anyway, but so what we needed to do was really to estimate, to provide an estimate of the loans that hadn't yet gone through the foreclosure process. And let me just show you how we did that. Pay attention to 6 numbers here that are in red. What you see here is in the top line here, and I'm sorry this pointer doesn't work, but you can see at the top for the first time period, the loans are all uncensored. So you have an observation of 25 months for the judicial states, 19 months for the statutory states. Now what we did then, as you go up, you can see this censored loan column, the percentages go up over time, obviously as you get to the more recent period. So more and more we're actually relying on a forecast. Period 5, when Lori Goodman and I first did this paper, period 5, we actually estimated that they were mostly at that point censored. We had actually estimated 40 months. So now that we've updated the analysis, I think we had a very good out-of-sample forecast. There you can see now they're about 45% uncensored, only about 50% censored. However, this last time period, this period 6, which is the one that's most interesting to us, are when the new CFPB servicing rules came in effect. And what we see here is they've gone up about 3 months in the judicial states. Now in the statutory states, they've gone up quite a bit more. So our original period 5 estimate was 22 months. We're under by about 2 months, so it's 24 months. But the new rules have it going up by 30 months. So they've gone up slightly in judicial states, but a lot more in the non-judicial states. And I'm going to actually provide some thoughts about that previously. Now, mind you, while I'm showing you these numbers, underlying it is a multivariate model, to try and control for all these things. Okay, well, estimating the cost turned out to be pretty challenging in the sense that what we're trying to do is tease out the time-related costs. Okay, so I'm not going to have time to go through the model for that, but this is the bottom line number that we came up with. So severity rates went up by 9 percentage points. That's losses as a percent of balance at foreclosure sale. Went up by 9 percentage points, but as you can see, 15 percentage points in judicial states, 24 percentage points in the highest cost judicial state, which is our neighboring New Jersey. Okay, well, the costs went up a lot. Again, we were surprised at the extent to which they went up, but if there's offsetting benefits, then you could say, well, maybe these are justified. So this is where we updated the Girardi, Lambie, Hansen, Willen paper, and you can see. So does it result in better outcomes for borrowers? And this is actually was another surprising result. Is that if you look at cures, which is down here, and again, now this actually they used did you use a competing risk hazard model, Lauren, for that?
This is just unconditional.
Okay, not sure. No, she said no, I didn't hear. Anyway, so again, we don't suffer from the same problem. Anyway, but you can see that it didn't result in more cures for the borrowers. So the cure rates were essentially exactly the same. Of course, there. Did it actually? And what you do see, though, is that obviously loans were put into foreclosure more quickly. But then by the end of the period, they started to converge. So they were put into foreclosure more quickly in the statutory states. But you can see the very end of the period, they start to converge. And ultimately, what you end up with is more persistently delinquent borrowers in the judicial states. Well, then the question is, did these extra timelines result in more modifications? And again, the evidence is no. That in fact, it's slightly more in statutory states, but not significantly so. Anyway, but at least in the first period that they looked at, and we updated, you can see that they're about the same. In the later period, I mean, one good outcome of maybe these new servicing rules is that we are seeing more modifications. But again, the judicial time provides no additional benefit for that, nor do they provide any benefit for the types of modifications that get done. Okay. Another thing is there's a paper here by some people in the audience. All three are here. Paul Kalem, Julapa, and Bill Lang did a paper. They find that the timelines are lengthened by 12 months. The borrowers that are delinquent on their credit card accounts, 11% are more likely to cure. It's not clear how much it is, but again, it's only the borrowers that are delinquent on their credit card balances that they come clear. So it's not clear that this is providing a big effect. This is providing a big benefit. One other thing that we talked about here are the effect on the boomerang borrowers. Okay, so in the case of the boomerang borrowers, Realty Track said there's about over 7 million of these are going to be entering the housing market. So we did some things. We pulled a sample of about 43,000 loans, and we said, well, what's the effect here in judicial versus statutory states? And not surprisingly, because the statutory state borrowers are able to get through the foreclosure process more quickly, they can re-enter the market more quickly. So the evidence here says statutory states are about 1.3 times as likely, 3.0 times as likely to take out a mortgage, 1.6 times in the 2009 period, which is kind of where you start to see the big differences, right? This is about 4 years out. So the fact that they've gone through the foreclosure process in the statutory states means that they're able to enter the market more quickly, I think, which is it's another benefit. Now, other costs, I think it's pretty clear, and I think a number of people have written on this. Each nearby foreclosure is found to lower a seller's price by an average of about 1%. 1% for each foreclosure. And so what you have here is a case of where a property is like surrounded by foreclosures that can have a very serious negative effect on the house prices. We have the issue of foreclosures may create disamenities, crime, property neglect, and the longer timelines can do that. And let me show you at least some of the, and this is the part of the paper, or this is the part of the paper where we update the analysis that Tracy did. Because there's been a lot of speculation out there that this is actually slowing the housing recovery in these states with these long timelines. There's more loans in foreclosure. We do find some weak evidence for this. What we have are, you look at the house price change from peak to trough, so you want to control for that. And on the vertical axis, it's the recovery from trough to April of 2014. So a more steeply sloped line indicates faster recovery, and the statutory states are actually recovering more quickly overall. But like I said, there's a model that underlies this. It's not as strong a relationship as you'd like, and it's not necessarily as strong a relationship with the long timeline states versus not. But definitely the relationship's there. That this is, and it's actually, it makes some sense. Okay, so let me provide one additional thing before we conclude. And that is to look at the foreclosure referral. So the CFPB implemented a policy that says you cannot foreclose on a loan before day 120. They just put a rule in effect that says you can't foreclose on a loan. And very rarely do you see a policy get announced and it show up so big in the data. So what we have here, you can see this. So what Lauren did was she took foreclosures of the first 3 months of every year, including from 2007 to 2014, and she said, when did they start getting into, or when did they get referred to foreclosure? And you can see from 2007 to 2013, somewhere between 40 and 60% of the loans were referred to foreclosure between the time they first went delinquent to day 120. 2014, the new policy got announced. It went down to 2%. So there's a direct, immediate effect from the policy, and that may be one reason for these, little bit longer timelines that we're seeing in the data. Okay, so again, since this is fairly new, very, very new policy that got announced in January 2014, we're looking at it. Okay, well, I think I'm pretty much on time, but let me get to my conclusions. Again, just to reiterate, judicial foreclosure review imposes large costs but does not appear to be generating benefits in terms of saved defaults or more modifications. When I was at CFPB, they actually asked me to say, well, what's a good benchmark? What number should we hit for, in terms of kind of optimal timelines? And Cutts and Merrill did an interesting paper where they came up with a number of 270 days. And they said if you really have an efficient process, you should give a borrower about 150 days to work out their loan. Whether or not, if the borrower's delinquent, what are they going to do? If you can't resolve it in that 150 days, then give them about another 120 days to kind of work through the foreclosure process. So their optimal period. Now, in fact, nobody hit that time. Even the statutory states, they weren't hitting that time. But that's a useful benchmark to think about. Of course, that requires that servicers are doing an efficient job. It requires everything, but we're obviously very, very far from that. So the future work that we have to do, and this is where it gets, potentially very serious, is really our increased cost of servicing delinquent mortgages, leading to a tightening of the credit box. Now, Lori Goodman just produced something for the Urban Institute recently, and hers is a definite yes, that she believes it is. The anecdotal evidence in talking to lenders and all is it also definitely is. And all. So it's something that we want to look at. Actually going in and proving it in the data is a little more challenging. Karen Pence did something like that. Anyway, but it's something that's worth looking at. Actually, Doug McManus asked me what he thought my reasons were for why the private label securities market is not recovering. One of the things that we did hear from some of the people in the industry is the uncertainty of the servicing rules. That'd be something that's obviously harder to prove, but it's something that we ought to keep in mind when we do this. And the other thing is, on the positive side, our servicing rules leading to more successful modifications. I know Deng here and Paul Callum, I know are going to be doing some work on that because we have a lot of information in the Y14 data. So that's one of the things that could be beneficial here. And then the other thing is, we still have this issue as a shadow inventory being there. So what's it going to look like in 6 months or whatever, or 6 months, another year, when the shadow inventory goes? Now, given the timelines, what's going on in New York and New Jersey, it's that it may be a while before we see the end of this. I have some other things. Anyway, so that's it. Thanks a lot.
Okay, thank you, Larry. So Mike Carhill will discuss the paper. Mike is the director of the Risk Analysis Division at the OCC. He oversees the DFAST stress testing at the OCC.
The quantitative support for stress testing. Thanks, Julapa, for the invitation. I apologize, I don't have a PowerPoint. Should provide one, and the reason I didn't, frankly, it didn't occur to me. I think the last time I acted as a discussant, PowerPoint hadn't been invented. So, I thought this was a very good paper. I think it shows that the housing crisis is still going on. The history has yet to be concluded, and I think this is a great paper. If it evolves over a couple of years, it may get the full history in there. And what we have in the housing crisis is really, we see it a lot in advanced management approach for operational risk, these really hyper-Parisian distributions. So if you consider what default costs would cost during a normal time compared to what they've cost as a result of the housing crisis, it's just, it's no way that's even in the distribution prior to 2008. And default costs appear to still be rising for reasons that Larry elucidated. I had the example or the advantage of having read the paper. They missed an important citation. I do find that Larry was very convincing that judicial foreclosure is a bad idea. If it ever comes up on the ballot in Virginia, I'm going to vote against it. But, there's a paper by Jiawei Zhang and Hua Tang, JFI Summer 2014, which also analyzes, not in terms of near the detail of costs, but just the lengthening of the timeline. And they had very similar numbers. They had the timeline going to plus 20 months for non-judicial, plus 40 for judicial. That's similar. Larry's got a little more recent data that shows the non-judicial's gone to almost 30% now. They had an interesting result that Larry did not have. Well, they had two interesting results. One's not really pertinent, but I find it so interesting that I'd mention it. And that's that origination or purchase originations compared to takeout refi or refi originations. The appraisal for refi was, they deduced from comparing the current loan to value to the original loan to value. The takeout refis, the appraisal was 20% higher than for purchase loans. So that led to a second finding, or is related to a second finding, which is very relevant for Larry's paper, and he didn't mention it, but they found that judicial foreclosure states had 20% higher delinquencies than non-judicial foreclosure states. So enough of that, but they also make the point that I think Larry ought to cite the paper, and they make the point that this judicial foreclosure is lengthening the timeline. They don't go into the costs, but clearly the cost is much higher. Just a few more comments briefly. In a pure laissez-faire economy, we would say all this stuff can get priced in the original auction. One of the factors that Larry, I think, ought to consider, or if possible, is the different recourse rules in different states. It's just as much an important dimension, I think, as the judicial versus non-judicial foreclosure. And I don't know how many states have unlimited recourse. I think there are some. There are many states that have recourse only to the home. I work a lot in California on exams, and they have the advantage, banks have the advantage, consumers have the disadvantage. In California, they can take either personal assets or the home, not both. That was sold as a pro-consumer right. It used to be they can only have recourse to the home. Obviously, it was sold on to the voters on false grounds. But anyway, that's a dimension that would add in here. And I think in the history of this explosion in costs for defaults in the residential mortgages, that that's just as important as the judicial versus non-judicial. So as I say, the market should price these in, and I wonder about the role of the agencies in establishing a uniform price. And this goes back to the day really when there was negligible default costs for mortgages, or almost negligible, 50 basis points or something like that, for a prime mortgage in the old days. And so Larry commented that one reason they didn't price it in is he did a study prior to the crisis, prior to 2008. It was like 2 basis point difference. I think that was judicial versus non-judicial. So not worth the trouble to price in given the politics of it. But in principle, the markets should price it in, and with the agencies playing the role they still play and setting a constant rate, they're not able to price it in, and that's why we see credit rationing, as was described, the evidence Larry has found for that. Another point, going back to this, my final point, going back to this idea of this really hyper-Parisian type distribution for costs of default in residential mortgages. Even though I'm saying the market would have priced the options in ex ante, the market would have had no idea how expensive these options were, so they would have badly underpriced them. So it's kind of a self-contradictory statement, but I can live with contradictions myself. So that's all my comments.
Okay, thank you, Mike. So, any questions? Yeah, Paul?
So on this point about when you go back and...
Use microphone, please.
Sorry, okay. The point about when someone gets access to the mortgage market again, so you're saying within 4 or 5 years after the foreclosure completion, or after the when the mortgage is no longer being reported as an active delinquent, you regain access. What does that have to do with your actual risk of default. So is this maybe more a problem for the credit scoring models that are used as opposed to a problem with the foreclosure laws?
Oh, no, we're not making a statement, we're just making an observation that, that you get, that you're able to get back into the market more quickly, because you've kind of cleaned up your.
Well, you've cleaned it up on the credit report, sure, but is that fundamental to your credit risk at that point? Is there any difference in credit risk between someone who's two individuals who defaulted, who went into mortgage default on the same date or delinquency on the same point in time, but one took longer to clear the credit report because they live in a judicial foreclosure state? Should they then have to wait longer to reaccess the mortgage market? That's a different, that's the fundamental question.
Well, that is a good question, and you think in principle, if it's just, it's just it, then, then maybe they shouldn't have to, but that's, but that's not the way these models are working. That's not the way it is. Now I know that one of the things they're talking about, I think Fannie Mae has a program, and I actually looked for this. Lori's in the audience, she might know, but actually I think they were saying if you've done like a short sale or something like that, you've been willing to, then your re-entry could be quicker. It could be as low as 3 years and things. So people are really thinking about this issue and all, trying to kind of adjust the models for that, for exactly the same exactly the reason that you're saying. But it's kind of one of the unintended consequences of sort of this belief you're providing more protections for the borrowers, is that at the end of the day, it's going to result in a slower reentry in the market. So.
Okay, Cordell?
So from the perspective of the overall social welfare, if the foreclosure timelines are longer, do the defaulting borrowers not receive the benefit of being able to stay in the house rent-free for longer? And if so, what are the, at least back of the envelope estimates of those benefits?
Yeah, we actually had that in the paper. I didn't put it in part because what we did was it was like $18,000 benefit versus $3,600 or something like that. Well, what we did was we just took the unpaid payments and say, okay, these are the these are the things that they forego. Which is, I didn't mention it part because I think that's probably the wrong way to look at it. It's kind of what is the foregone rent, I think, is what you do to really do that right. And yes, that's certainly a benefit. And I know when we talked to the people at the CFPB, they were talking about that as well. So I think it's fair to say, and we have it in the paper, I just didn't have time to discuss it, but that's fair to say that is an offsetting benefit. But then you have to weigh that against, of course, all of the other costs that we have here. But yes, thanks for pointing that out. I didn't, like I said, if I had enough time, I would have brought it up.
And a point in favor of rationality in the Journal of Fixed Income paper, that's probably why there's 20% higher delinquency in the judicial foreclosures, extra benefit.
Yeah. Andy, I think he had, maybe we should just take one more. I think we're kind of going into the break. But anyway.
All right. If you looked at the loans that went into foreclosure starting, let's say, 2012 or 2013, so people who didn't become delinquent until then, are the foreclosure timelines really extending for those people as well? Or is this really just sort of people left over that are, so it's very bimodal now in terms of the timelines? So we have some people who, were bad loans, they're really expensive to resolve, there's no real paperwork, and they're extending, or is it really the new foreclosures are also extending them?
Yes, and in fact, that's what I didn't, again, I didn't have enough time to talk about it, but that table where we have the timelines, those were defaulted within those periods. So that it became 180 days delinquent, period 1, 2, 3, 4, 5, and 6. So that's what those timelines are representing. So these are actually new foreclosures, even in period 6 that we have. So we're talking 40 months versus 24 months in the period 5. Those are brand new foreclosures. But thanks for asking that. Anyway.
Okay, so we are going to take a break for 25 minutes. There's one more session before lunch, so lunch will be a little late. So there are some snacks and drink outside, so please take some snacks. Thank you.